Cryptocurrency markets are renowned for their rapid price swings and inherent volatility. While gains in this space can be substantial, protecting those gains is just as crucial for long-term financial stability. Hedging strategies provide participants with conceptual tools to manage risk, maintain liquidity, and ensure portfolio resilience during periods of uncertainty. In this video, we will explore multiple approaches to hedging crypto holdings, including diversification, stable asset allocation, risk assessment, monitoring market cycles, and strategic rebalancing. Understanding these strategies conceptually allows participants to minimize exposure to unexpected downturns while remaining engaged in potential growth opportunities. Press the subscribe button and activate the notification bell to receive ongoing updates on responsible cryptocurrency practices. By applying these principles, participants can navigate volatility with a disciplined mindset, maintaining control over their investments. Let us begin by examining the fundamental concept of hedging and why it is essential in cryptocurrency. 1. Understanding the concept of hedging. Hedging is the practice of reducing exposure to unfavorable market movements in order to protect accumulated gains without eliminating the potential for growth. In cryptocurrency markets, where volatility can produce rapid and dramatic price swings, hedging serves as a structured framework for risk management. Awareness of market dynamics, investor psychology, and asset correlations enables participants to make informed and calculated decisions. Conceptual hedging encompasses strategies such as diversification, allocation to stable assets, monitoring market cycles, and disciplined portfolio management. Participants benefit from understanding that risk cannot be fully eradicated, but can be managed through systematic approaches. Recognizing the importance of hedging encourages disciplined behavior and prevents impulsive, emotion-driven decisions. 2. Portfolio diversification. Portfolio diversification is one of the most fundamental tools for hedging in cryptocurrency markets. By spreading investments across multiple tokens, projects, or asset types, participants reduce dependence on any single holding, limiting exposure to extreme losses. Awareness of correlations between assets is crucial, as holdings that move in tandem may not provide meaningful protection. Conceptual diversification involves balancing large-cap coins, mid-cap projects, emerging tokens, and alternative digital assets. Knowledge of market trends, technological adoption, and project fundamentals informs the strategic selection of assets. Proper diversification allows participants to engage in growth opportunities while managing risk. Observation of liquidity, network activity, and historical volatility strengthens the effectiveness of diversification. While diversification cannot eliminate risk, it provides a conceptual buffer during turbulent periods. 3. Stable asset allocation. Stable asset allocation is a vital component of hedging. Allocating a portion of holdings to stablecoins or low volatility assets provides a conceptual safety net during periods of high market turbulence. Awareness of market cycles and volatility guides the appropriate proportion of stable allocation, ensuring participants retain flexibility while protecting gains. Stable assets preserve value, maintain liquidity, and reduce emotional stress during sharp market corrections. Knowledge of issuer credibility, collateral mechanisms, and liquidity depths supports informed allocation decisions. Incorporating stable holdings allows participants to exit volatile positions partially without fully abandoning long-term opportunities. Observation of adoption trends, exchange activity, and macroeconomic conditions enhances the conceptual framework. Stable allocation complements diversification, creating layered protection against market swings. 4. Risk assessment. Risk assessment forms the foundation of effective hedging, offering a structured approach to evaluating potential exposure and losses. Awareness of market volatility, liquidity conditions, and macroeconomic influences allows participants to make informed and deliberate decisions. Conceptual risk assessment involves analyzing portfolio sensitivity, concentration risk, and behavioral biases affecting decision-making. Knowledge of potential loss scenarios, support levels, and historical market reactions strengthens preparedness. Regular review of risk factors ensures strategies remain aligned with current conditions. 5. Avoiding emotional decisions. Emotional decision-making can significantly undermine hedging efforts. Market volatility often triggers fear, greed, or panic, leading to impulsive choices that erode gains. Awareness of psychological influences allows participants to act strategically, adhering to conceptual hedging principles. Discipline in observing market conditions, rather than reacting impulsively, preserves capital. Recognizing behavioral triggers and avoiding panic selling or FOMO-driven purchases supports long-term portfolio resilience. 6. Using conceptual hedging instruments. Even without direct trading, understanding hedging instruments like options, futures, or derivatives provides valuable conceptual insight. Awareness of their theoretical usage, limitations, and risks informs strategic thinking and market perspective. Knowledge of professional practices in hedging enhances understanding of portfolio protection mechanisms. Observing how these instruments interact with market movements offers insight into broader risk management strategies. Conceptual familiarity allows participants to evaluate potential protective measures without exposure to complex execution risks. Awareness of instruments supports informed evaluation of price trends and market behavior. Knowledge and observation strengthen strategic literacy and preparedness in volatile markets. 7. Monitoring market cycles. Market cycles greatly influence portfolio performance and the effectiveness of hedging strategies. Awareness of accumulation, bull, distribution, and bear phases enables participants to anticipate shifts in market sentiment and price trends. Conceptual understanding of cycles reduces the likelihood of reactive or emotionally driven decisions. Observation of volume, price action, adoption rates, and sentiment provides early indications of cyclical changes. Aligning hedging strategies with market cycles preserves gains during corrections and optimizes allocation during growth phases. Knowledge of historical patterns reinforces the ability to make informed adjustments. Awareness of cycles fosters disciplined planning and long-term stability. 8. Liquidity considerations. Liquidity is a critical factor in hedging as it determines the ability to adjust positions during periods of volatility. Awareness of exchange depth, trading volume, and potential stress events guides allocation decisions. Conceptual liquidity planning ensures that participants can execute portfolio adjustments efficiently without undue slippage or delay. Knowledge of which holdings are easily convertible during market stress informs strategic allocation. Observing transaction costs, market spreads, and exchange health reinforces practical awareness. Maintaining sufficient liquidity enhances flexibility and protects gains during sudden downturns. Awareness of liquidity complements diversification, stable asset allocation, and cycle monitoring in comprehensive hedging strategies. Knowledge, observation, and discipline planning strengthen overall portfolio resilience. 9. Gradual rebalancing. Regular portfolio rebalancing is an essential component of hedging. Awareness of overexposed or underexposed assets allows participants to make measured adjustments. Conceptual rebalancing focuses on maintaining intended allocation ratios, reducing emotional reactions to short-term volatility. Knowledge of price trends, asset performance, and market cycles informs the timing and extent of rebalancing. Systematic adjustments help capture gains while minimizing exposure to losses. Observation of liquidity, trading costs, and market depth supports effective execution. Gradual rebalancing complements diversification and stable allocation strategies. Awareness of portfolio drift prevents unintended concentration in volatile assets. 10. Combining strategies. Effective hedging combines diversification, stable allocation, risk assessment, cycle monitoring, liquidity planning, and rebalancing into a cohesive framework. Awareness of each strategy's role allows participants to preserve gains, maintain flexibility, and reduce exposure to volatility. Conceptual integration ensures that no single approach dominates, but rather complements the others in a balanced manner. Hedging is a vital tool for protecting crypto gains in a volatile market. Awareness, strategic planning, and disciplined application of conceptual strategies allow participants to manage risk while maintaining long-term stability. Share this video with others to help them understand the importance of preserving gains. Comment below which hedging strategy you find most effective and how you approach risk management. Press the like button if you found this video valuable. Subscribe for more educational crypto insights and activate the notification bell to stay updated. Remember, knowledge, observation, and disciplined execution are the strongest tools in navigating cryptocurrency responsibly. Applying these strategies ensures that participants maintain control, protect capital, and engage in the market with foresight and confidence. Strategic thinking, patience, and awareness are your most powerful allies in safeguarding gains and building sustainable wealth in cryptocurrency markets.